Insurance can seem complicated, but at its heart it's pretty simple. It's about people coming together. They share risks. They help each other out when things go wrong. That's cooperation in a nutshell. Think of it like a giant potluck. But instead of bringing potato salad, everyone brings a little bit of money. This money goes into a big pool. Then when someone has a car accident or their house floods, they can take some money out of the pool to help cover the costs. But for this to work, everyone has to play fair. People need to trust that the insurance company will be there for them when they need it. And insurance companies need to trust that people are being honest about their risks and their claims. So yeah, insurance is basically a giant trust fall into a pool of money. Sounds risky? Well, it kind of is. But it works surprisingly well mostly. Risk pools are the heart of insurance. They're how insurance companies spread risk and keep premiums affordable. Here's how they work. Everyone pays a premium, which is a fancy word for money you give to the insurance company. This money goes into the risk pool. Most people hopefully won't need to use the money, but some people will. They might have a car accident, get sick, or their house might catch fire. That's when the risk pool comes in handy. The people who need help can take money out of the pool to pay for their expenses. This is why it's important for everyone to contribute. It's like a giant safety net, but instead of catching people, it catches financial disasters. The bigger the risk pool, the more money there is to go around. That means lower premiums for everyone. It's like a group discount for not having your life fall apart. Well, not completely apart. Trust is super important in insurance. It's like the foundation of a house. Without it, everything crumbles. But trust goes both ways. Policyholders need to trust the insurance company. They need to know that the company will pay out when they make a claim. They need to know that the company won't just take their money and run off to a tax haven. Not that that's ever happened, but insurance companies need to trust policyholders too. They need people to be honest about their risks. They need people to not commit insurance fraud, which is a fancy way of saying lying to get money from the insurance company. This whole trust thing is built on something called good faith. It means everyone is acting honestly and fairly. It's like the opposite of that friend who always cheats at Monopoly. Don't be that friend. Section 4. Insurance. It's like a safety net for everyone. Insurance isn't just about protecting individuals, it's about protecting society as a whole. It's like a giant safety net that catches us when we fall. Metaphorically, of course. When people have insurance, they're more likely to take risks. They're more likely to start businesses, invest in their education, and buy homes. These are all good things for the economy. They create jobs, boost innovation, and make everyone richer in theory. Insurance also helps reduce the impact of disasters. When a hurricane hits or an earthquake strikes, insurance companies are there to help people rebuild their lives. They provide financial assistance so people can get back on their feet. It's like a financial first aid kit for society. Section 5. Playing fair in the insurance game. Fairness is another big deal in insurance. It's about treating everyone equally, regardless of their race, religion, gender, or love of Nickelback. Insurance companies can't discriminate against people when setting premiums or handling claims. Everyone deserves access to affordable insurance, regardless of their background or how many cats they own. This is where regulations come in. Governments have rules in place to make sure that insurance companies are playing fair. These rules are like the referees of the insurance game, making sure everyone is following the rules and no one is getting cheated. Section 6. Following the rules, why compliance matters. Insurance is a highly regulated industry, and for good reason. There's a lot of money at stake and people's lives are on the line, so it's important that insurance companies are following the rules. These rules cover everything from how insurance companies can invest their money to how they handle customer data. They're designed to protect consumers, prevent fraud, and ensure the stability of the insurance industry. Insurance companies that don't follow the rules face serious consequences. They can be fined, sued, or even shut down. It's like getting a red card in soccer, but instead of being kicked out of the game, you're kicked out of the entire league. Section 7. Teamwork makes the dream work. Insurers and partners. Insurance companies don't operate in a vacuum. They work with a whole bunch of other organizations to get things done. It's like a giant team-building exercise, but instead of trust falls, they're figuring out how to pay for your car accident. They work with reinsurers, who are basically insurance companies for insurance companies. They work with governments to develop disaster preparedness plans and provide coverage for things like flood insurance. They also work with consumer advocacy groups to make sure that insurance products are fair and affordable. It's like a big, happy family, except they're all trying to make money off of each other, but still teamwork.